Okay, I'm just going to be honest. While I am bullish on a year-end or Santa Claus rally, I'm a little nervous for tomorrow. I'll explain why in this video, and if it does not make sense, let me know what you think, your input, down below in the comment section. But here on the day today, we did get above 600 on the SPY. We quickly reversed under 600 after briefly holding above 600 for about 25 minutes. But the reason I'm really concerned about tomorrow is we have a lot of data coming out. So we have core PCE month over month. We're expecting 0.3%, the same as last month. If it comes in higher, that's bad. If it comes in lower, that's good. It's pretty straightforward. We have durable goods orders month over month. For October, you're expecting a positive 0.5%. Last month was negative 0.7%. We have a GDP growth rate quarter over quarter, second estimate for Q3. Last estimate we had was 3%. We are expecting this to fall to 2.8%. Personal income month over month is expected at 0.3%, the same as last month. And personal spending month over month came in last month at a 0.5% positive. We are expecting 0.3%. Now, beyond that, all that data comes out at 8:30 in the morning. We also have initial jobless claims, expecting that to come in at 216,000 PCE price index month over month and year over year. Not the core, but the headline numbers. You will get wholesale inventories, continuing jobless claims, as well as the Chicago PMIs that come out at 9:45 in the morning, and pending home sales month over month and year over year. Now, I'm a little nervous for this data. Why? Because we have pretty high expectations that the economy is still doing well. And if the economy is doing well, that's good. Now, if inflation comes down at the same time the economy is doing well, that's the best case scenario. But if there's any oopsie doopsies in that data, we're all of a sudden going to have a big problem on our hands. Now, specifically, I'm nervous for tomorrow because of the VIX. Okay, the VIX today is down 3.36% to 14.09. At one point, it was under 14. It was in the 13s. Volatility has picked up a little bit towards the end of the day. But you are back to levels we were at in July of 2024, or levels that we were at, really from May until July, right? You had a higher VIX in April of 2024 than you do today. And even though there's a strong, bull thesis right now, I believe, with cash on the sidelines, the Fed cutting rates, the economy still doing okay, inflation, while bumpy still coming down, we got to acknowledge the bull case here. But it doesn't seem like anyone is hedged for the downside scenario, right? The VIX is just monitoring the puts and call activity on the SPY, on the S&P 500. So when there's not a lot of fear out there, the VIX is low. When there's not a lot of fear out there is a pretty good indication that everyone's bullish. And when everyone's bullish, you can get these, slaps in the face, right? This snapback to reality on very short notice that can cause the VIX to spike, that can get people's, attention. And that can be a data report, that could be a bad earnings, that could be any number of things, geopolitical tensions. But when there is this much complacency, you're vulnerable. That's the bottom line. You're vulnerable for a situation where maybe personal spending comes in low and people are like, oh crap, are we actually going to have a soft landing? Maybe the interpretation of the odds of a soft landing come down. Maybe if everyone's at 100% chance of a soft landing, maybe we get bad economic data and that falls to 90 or 85%. That's going to have a pretty dramatic impact on equities, okay? Or inflation. If everyone thinks, yeah, inflation's a little bumpy, but it's generally falling. And then you get a really hot PCE report, then everyone's like, oh crap, maybe the Fed might actually raise rates. Now, that's not my base case scenario for tomorrow morning's data. Just you're kind of off sides here, right? Everyone is in the bull camp category, whereas nobody is even remotely concerned. And I mean, that's a problem. Okay, just take a look at this, right? Wow. I mean, wow. We had a big miss today on October new home sales coming in at 610,000 versus the 725,000 estimate, while month supply of new homes rose from 7.7 to 9.5. Higher mortgage rates last month contributed. More prints like these would imply a cooling in home prices or concessions from builders. So that's actually good, right? If home prices come down, there's a greater chance that homeowners' equivalent rents will also come down and CPI will come down as a result of that. But it's also showing that people are not buying homes. So maybe their, financial situation's not as good as we think. And total unsold new homes for sale now at its highest level since December of 2007. But really what has me a little bit concerned today is all of the price targets coming out for next year. Bank of America raises their year-end S&P 500 target to, you really can't make this up even if you wanted to, 6,666. I think that's a bad just market omen. Correct me if I'm wrong, but that's just not super good. Now, Deutsche Bank wrote this. They say the bull market is poised to extend through 2025, boosted by solid demand for stocks from investors as well as strong corporate activities, such as buybacks and other spending. According to Deutsche Bank, which is calling for the S&P 500 to rise as high as 7,000, Binki Chadha, chief global strategist at Deutsche Bank, set a year-end 2025 target for the S&P 500 of 7,000, which would translate into a 17% gain from current levels. They say, quote, "We see robust equity and bond inflows continuing, boosted by strong risk appetite," Adhida said in a note to clients. "We see S&P 500 buybacks rising from an annual run rate of 1.1 trillion currently to about 1.3 trillion next year, rising in line with earnings. We see the demand-supply backdrop for U.S. equities remaining solid, even with conservative assumptions, pushing the S&P 500 to around 7,000 next year." I mean, it's one of those situations. Just think, for an example, NVIDIA. If everyone is bullish on NVIDIA, it's very hard for the stock to go higher after earnings, right? Because everyone already has high expectations. They're already expecting good things. And that's kind of what happened this last earnings. NVIDIA is currently a $135 stock, down from that 150 level, which was its all-time high, even though NVIDIA blew earnings out the park, like Babe Ruthed their earnings. Okay, it just wasn't enough to impress investors, so the stock did not go up. Think about it like this. If everyone was super negative on NVIDIA heading into this latest earnings, and NVIDIA gave us the earnings they did with lower expectations, NVIDIA would probably be a $160 stock right now. Okay? It's all about expectations. And now that you're getting more of these year-end targets that are all very bullish, the odds of a disappointment in the short term are growing, okay? Anything that derails the possibility of a large, an extensive bull market next year is a problem now, because the markets are forward looking. So we're growing our expectations now for what we're going to see in 2025. Hotter than expected inflation report, meaning that the Fed may not cut rates at all or might even raise rates next year, is a big problem. Weakening economic activity is a big problem because we're not expecting that. I just think that, this market, at least in the short term, is vulnerable for maybe big swings in the economic data, in which we really have not seen that in a while. Like the pending home sales data that we got this morning. That was an epic miss, like a disastrous number. I mean, if we were to get something like that, with a more important data point, that could set markets up for a lot of volatility. That doesn't mean it's going to happen. That just means I think the odds are higher of that happening than they are during just any normal market. Now, you also have the S&P 500 that is now trading at its fourth highest trailing PE in the last 124 years. Bar chart says probably fine. Now, valuation is one of those tricky things. I say sometimes that valuation doesn't matter. It doesn't matter until it does, meaning that it doesn't matter until something changes. Nobody wakes up one day and sells a stock or an index for that matter because it's expensive. Okay, valuations notoriously are a terrible way of trying to calculate future returns, right? At least in the near term, in the next couple of years. So nobody does that. The only time valuations are a problem is when something changes, when perhaps the data tomorrow could change something, right? If inflation were to go higher or if the economy were to be weaker, that's where valuation is a problem, because valuation is really just telling you that markets are confident in the path ahead for the economy. They see it as likely that they are correct, right? That growth is strong, that inflation continues to trend lower. It's just a confidence measure more than it is really anything else. If something comes along that spooks investor confidence, that's when valuations become an issue. So I don't know if that's going to happen tomorrow. I just think it's a risk that we should definitely be attentive to. Now, Nick Timmerhouse on X gives us really the most important part of the FOMC minutes today. And it says here, in discussing the positioning of monetary policy in response to potential changes in the balance of risks, some participants noted that the committee could pause its easing of the policy rate and hold it at a restrictive level if inflation remains elevated. And some remarked that policy easing could be accelerated if the labor market turned down or economic activity faltered. So really, whatever the data says, if the data says inflation's running hot now, or if the economy is cooling, that's what the Fed is going to respond to. Like, there is no guarantee at this point to what the Fed is going to do. If the data comes in weak, the Fed will likely cut. If the data comes in strong and inflation comes in high, then the Fed's not going to cut. They're going to hold at, more restrictive levels for longer. Now, following the FOMC minutes today, the markets actually priced in a greater chance of a cut coming September 18th. Markets actually are pricing in now a 62.1% chance of a Fed rate cut for December 18th, and only a 37.9% chance of a pause, which is, it was about 50-50 yesterday between a cut and a pause. Now, the FOMC minutes also said today that Fed officials see interest rate cuts ahead, but only gradually. So, kind of what the markets had expected. We went from pricing in over 8 cuts for next year. Now we're only expecting about 3 cuts for next year, which I think is pretty appropriate. But again, what if inflation comes in high? What if, the economic data starts to come in bad? That's gonna mess up the expectations, and that's where the issue could be in markets, especially as you hit these high levels. Now, last night, it was reported via Trump that he vows an additional 10% tariff on China, 25% tariffs on Canada and Mexico. It looks like it was pretty fast to get the Mexican president that said migrant caravans are no longer arriving to the U.S.-Mexico border. Mexico's president said, quote, "I'm of the view that we'll reach an agreement with the U.S." He also says, we are seeking to meet the US as soon as possible. So they're already trying to get their acts together. Now, the market's seen this today and said, wow, maybe that's all we get in the form of tariffs. Or at the very least, maybe it's going to be a little while now that we hear anything about new tariffs, right? We just heard 10% tariff on China, 25% on Canada and Mexico. Like, when are we going to get the next tweet? It could be a while. That's what Wall Street is saying. And that's why the VIX today is down to 14.04. It's down almost 4% today, even though risk on areas of our markets like the Russell 2000 down almost 1%. I think part of that has to do with the Russell's really been outperforming recently, and you're getting a little bit of a consolidation of that rally. But the markets looked at the Trump tariff, tweet or truth. I don't really know. Retruth? I don't know. As positive, right? Because if that's all we're going to get, and Trump was campaigning for 60% blanket tariffs on China, then that's positive. Now, I don't think that's the last we're going to hear about tariffs by any means, but Wall Street's kind of jumping to that conclusion, at least for the near term. So we talked about this last night. The tariff situation was likely going to be good news until we get new tweets about new tariffs. That's where markets will likely start to freak out. So it just feels like heading into tomorrow, we're a little too complacent, especially with the big miss that we got on data today. If that's for forecasting or preceding a big miss on data tomorrow morning, that could be a problem. But I want to be very clear. I think, again, there's a strong bull case for a year-end rally. I don't think markets are too euphoric. The average stock in the S&P is trading at pretty average valuations. This is not like 2021. I think we'd have to see a lot more euphoria coming into markets before this was another 2021 kind of scenario. So there is more room to run to the upside here. That's for sure. But there's also that risk to the downside with valuations as high as they are. And now that we are right at about 600 on the SPY, this is likely going to be a major rejection level or a major rally level, right? If we break above 600 and run over the next day or two, that's a pretty good sign. Now, Tom Lee recently says he expected the S&P to reach about 6,100 by Friday, which from here would be upside of about 1.6%. Decent move for really just tomorrow, right? And then a half day on Friday. That's all we have left in this week. So not much time at all. So let me know what you guys think about this down below in the comment section. If we did get a little bit of rejection, if data did come in bad or something along those lines, then I think you'd be targeting that 20-day moving average at about 589 or so. That would be the level to be watching for. If we look at the Bollinger Bands, that again, that 20-day moving average around 589, you tend to revert back to that over time. That would be some support coming in most likely. You are close to the upper end of that Bollinger Band, but the upper end of that Bollinger Band, if we were to hit it, would be at about 610. So I think by the end of this week, you could be looking at 610 on the high side and 589 on the low side, potentially as low as 584 if we were to get a bad surprise from the economic data tomorrow. So let me know what you think about this information down below in the comment section. Obviously, I'm not a fortune teller. I'm not a financial advisor. I'm not making a huge conviction call here, but I think there is a risk heading into tomorrow that a lot of Wall Street is not paying attention to, and you see that reflected in the VIX today. Typically, you don't see the VIX fall 3.5% before core PCE, personal spending, durable goods orders, a new GDP quarter-over-quarter number. That's pretty atypical. Just that in and of itself. So let me know what you guys think about this down below again in the comment section. Have a great rest of your day, and I will see you in the next one.